Why did I miss my last newsletter edition? Because my laptop broke. And I'm using that today to jump into things breaking. When you're looking at property, it's important to look at what if, the things that can and will go wrong at some stage in the life cycle of your property journey. Today, we're going to look at investing. This is going to be a whistle stop tour. There's going to be 5 quick points just to get you noodling on the concept of investment or things you may have either glossed over or maybe not given the time they need. First and foremost, I want you to look at risk. Everyone's version of risk is different. You could have two people in a room, they both jump in their cars to go to a meeting or to get their haircut. One of them parks and gets out, parks the car wherever they can, jumps in. They could be on double yellow lines, they could be in a 1 hour parking space, they could be in loading bay, whatever it may be. But the idea is the same. They run in, get their haircut, have their meeting, and come out. Maybe they're clamped, maybe they're not, maybe they got a ticket, maybe they didn't. That's one element of risk. Then you have the other person that parks, they pick a very curated spot, they're very careful, they're thoughtful in what they're doing. Before they leave the car, they open the app, get the money ready, and pay for the adequate amount of time just in case they get clamped or just in case someone comes along. Neither is right and neither is wrong. They're both different, but the concept is the same when it comes to investment. When you look at risk, you're going to have some people that don't want to address the risks or have a different risk profile when it comes to investing. Some people don't wake up at night worried about their pension or worried about a pot of money that maybe either have diminished, decreased, or where they're going to get their next paycheck from. From an investment perspective, you want to be very clear as to what your profile is because you have to imagine the what if with your investment. What if the market is really hot, there's a lot going on, you're in great demand, your property you seem like you've made all the right moves. And then what if it does the absolute opposite, which it will at some stage in its life cycle? And there's a variety of factors to look at. I want you to look at that risk element as to why you're looking at something and what your intention is behind the investment. Please do away with dinner party conversation where one person who happens to make 10x what you make invests a few $100,000, whatever it may be, in Portugal, Spain, France, England, Ireland, wherever. And they almost kind of don't go into the detail of how important it may or may not be to them. Don't apply their circumstances to you. So be very clear about what your risk tolerance is when beginning the journey into property investing. The next thing I want you to look at is vacancy. When you're searching for a property to invest in, you want to work through what that actually looks like. People assume the market is extremely busy, and as soon as you have a property, it doesn't matter whether it has a front door or not, it will be rented by the perfect candidate who will always pay you on time, every time. Thank you for the privilege of it. That is frankly not the case. Markets shift, people change, and needs change as well with the economy. You could have someone on the periphery of Dublin or other cities such as Galway or Cork paying a premium because of the market. If the market shifts or changes in any capacity, or the vacancy rate change in certain central locations, people on the periphery may choose to pay a similar rent in a more centralized or highly populated location. If you choose somewhere that seems great now because anyone who picks a property seems like they can't make a mistake, you are already making a mistake. Always look at the what if when it comes to your property search. You want to imagine there's going to be a vacancy rate for a period of time. You want to imagine that just because you buy it today, put it up for rent tomorrow, and it rents the day after, that person is going to happily stay there ad infinitum, happy to take any rental increases. They'll look after the property and there'll never be any challenges. We make plans and God laughs. And there are people who rent for the entirety of their lives, and there are people who have a plan today that changes tomorrow, and that can also change your plans. So keep that in mind when you're assessing your associative elements of risk, but also the vacancy rate when you're looking at property. Look at pricing in the area and don't just pick the highest price and hope for the best. Look at the broad stroke of history in an area. Try and get an idea as best you can with information to hand as to the rental history of a location, and take a view to what if that didn't rent as fast as I think it may do in an ideal market. Thirdly, I want you to look at the rising costs. When people look at investing, they assume, well, I've got 500,000, £1,000,000, and if that's cash, that's going to have an intrinsic value, but inflation is going to take a hit when it comes to the value of your cash. But it doesn't mean that everything stays stagnant either. If you buy a property today, there are going to be associated costs with interest, rising costs and annual fees. If you're buying in an apartment block, you're going to have taxes that may potentially change over time. And it's important to look at what rising costs mean to you and your investment journey. If you have the money to weather the storm, that's different. Someone who has X amount is essentially financially free or financially independent. They may take a chance on certain things, but it's 99% of the time a calculated chance that if they lost it, it's not going to impact their life. But I want people to look at the other side of this coin, which is, what if I did this? What if I did that? And what would be the knock-on effect to me financially, personally, and mentally if it wasn't to go to plan? And it's not to be pessimistic, but once you look at both sides of the coin, you are then going to be a little bit more neutral in your decision making. It's not a case of buy this, it's always upside and nothing ever goes wrong. You are going to have vacancy, you are going to have challenges with rising costs, and it's important to acknowledge that. Fourth, I want to look at liquidity. I think nowadays we're getting very like America because we have credit to beat the band. People make an assumption that because you can go in and buy a car and you don't have to pay X amount, you can get whatever you want and it's very attainable. But you have to imagine when it comes to your costs, you have to really stress test yourself in your own circumstances as to what that will mean. Let's say COVID, you had people who were paying rent 1 minute and then maybe not paying the next. They had circumstances change. You had landlords that had to make a decision to hold firm, to maybe work with the tenants and do the best they could, or find alternative means to keep the lights on. And when you're looking at liquidity, I would generally say between 3 and 6 months at least of funds in place to be able to cover any eventualities or vacancy rates within the property or unknown costs. You buy a property and the moment it's built is the moment it starts to degrade. It may be slowly but surely, but sure as night follows day, work will be needed on the property. So it's important for you to look at liquidity when it comes to your costs and how you can make the right decisions. If you are going shopping when you're hungry, you're going to make a decision that may not be the ideal decision when you're full, when you've eaten. And when you're looking at this property journey, you want it to be a case that you're buying something for the right reasons, for the right investment. Once you've assessed every avenue, you can say, okay, well, I've worked through the what if. I've worked through if there is a vacancy rate. I've worked through if there is an unknown cost. I've worked through finances or interest rates change or alter or can really severely disrupt my deal flow or my cash flow. And it's not a case that you then want to say, well, I have to sell this because I didn't crunch my numbers. Crunch your numbers and go through the worst case. Be pessimistic. If someone's stress testing you to X percentage, do your own internal test. If this happens and that happens and we get a COVID part 2, or if there's a local change in infrastructure, or if there's a mass layoff in a certain area, what would that do to this property hypothetically? And it's important to then say, right, I'm now aware of that. I'm putting money towards it. And if something does happen, you're measured, you're controlled, and you can make decisions with a level head. And that's extremely important. And then I think it's the what if. So what if kind of covers a myriad of things. But let's say what if you're in a position where you're currently making a lot of money, but you may not have tenure. You may not know how long you're in a position or how long that's going to last. You may be coming towards the end of your working life in terms of your pension may be approaching. You may have decided that your risk profile for what you do for a living may change. So you could be in a high powered job making 300 to 500 grand a year, but you decide you want to open a bakery. You'd be surprised how many people I meet who are high powered that wish they were doing something like that. What role does that play in your investment journey? So when you're looking at the what if, I look at the what if personally, which is my lifestyle. What does my lifestyle look like now? What are the potential changes? Have I got family members that will need to be supported? Maybe family that are going to be getting married at some stage. They may need financial help, or it could be family that are studying and you may want to have a place that's near that to support them so it has some sort of capital appreciation. There's what if in the market, in your localized area, infrastructure, jobs, lack of jobs, the environment, the economy, everything. If you look at a what if from a broad stroke, and this is where the likes of ChatGPT can be your best friend, do not take it as the Bible from the perspective of what it says, but it can really get you thinking on a variety of what ifs that you can say, well, if this happened, how would I deal with it? What if this happened? How would I react? It's important to assess those. So this week, in this investing journey, the 5 things I want you to look at are risk, vacancy, rising costs, liquidity, and the what if. In the meantime, I'm going to do another newsletter next week to make up for my lacking one last week. Have a great week and enjoy the sun while it lasts.